And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. And, of course, we're going to go deep into some very interesting topics today, including exchange-traded funds, but also ESG, environmental, social, and government. Huge inflows into ESG this year, and especially in May. Huge inflows into ETFs in general, but especially ESGs. So we're going to talk about that. Joining us to discuss that, the man who runs the biggest ETF family in the world and the biggest ESG suite of products. That's Armando Senre, the head of BlackRock's iShares Americas, along with Sal Bruno, the chief investment officer of Index IQ, who also runs an IQ ESG ETF as well. That's also outperforming the S&P 500. And my old friend Todd Rosenbluth from CFRA. Armando, I've got used to saying amazing inflows into ETFs, but amazing inflows into ESG again this year. I'm looking at ESG inflows in the first quarter of the year, $21 billion in inflows into ESG funds. There was $21 billion in all of 2019. So we've already done, the first quarter of this year has already had the same flows as 2019. I know we keep saying, well, there's a new generation of investors and they're interested in climate change. Is that really it? Does that explain this avalanche of money coming into ESG, or is there something we're sort of missing? Look at these numbers here going up every single year, every single quarter.
Yes, Bob, and great to be here. Let me just say that I don't think it's that. I think that it's the realization that investment risk and investment performance, that's what ESG is about. It's not about compromising performance, and it's not just about values. So it's that convergence of values with the realization of investment risk and investment performance. So what you see is more investors incorporating sustainability into their portfolios, thinking about how ESG-related risks may have an impact on their portfolio and therefore on asset pricing. I think that that's why you see this massive increase in flows. And by the way, we think that we're just at the very beginning. Yes, in iShares, we just crossed 100 billion in sustainable ETFs globally. Half of that coming from the US. So this is no longer a European story. This is a global story. We see the same thing all around the world. But the reality is we believe the category will be $1 trillion by 2030. So we're just at the beginning. How does that happen? You see here in the US, you see a lot of model portfolios in the wealth segment incorporating ESG into the model portfolios, not only in sustainable models, but also in traditional models. So beginning to incorporate sustainability in their traditional models. And you also see it, as we talked before, with large asset owners around the world incorporating sustainable in their portfolios, like in the case of LCTU, we talk about CalSTRS. So that's what's driving the growth, and we're just at the beginning.
Yeah. Sal, you also run an ESG ETF, the IQ ESG ETF. The symbol is IQSU. You've been outperforming this year, also big inflows. And maybe pick up on what Armando was talking about there, not just climate change, but there's gender equality issues. There's the whole stakeholder versus shareholder issue. This is sort of that perfect confluence, as well as, of course, a younger generation of people that are interested in this. But pick up on what Armando was talking about there and why we keep talking about ESG as the moment that it's having right now.
A lot of what Armando is saying. And for us, we think that this is the acceleration and continuation of the trend that we had seen basically going on for several years. But if you even go all the way back, to 15, 20 years ago, if you think about what ESG investing was back then, it was really only about excluding certain types of companies. And that has evolved so much more so that it's really more of a comprehensive or a holistic view of, you're right, the stakeholder versus shareholder issue. And that's why we've partnered with Candrium, who's one of our sister boutiques under the New York Life umbrella. They have a long history of doing the ESG investing over in Europe to try to find best-in-class type of companies that cut across E, S, and G. And to us, I think an important part of this evolution is the fact that ESG investing went from being a satellite or a fringe type of an investment strategy to much more of a core type strategy. And we're seeing a lot more investors using it in their core piece of their portfolio. So they're looking for things like very competitive fees, lower tracking error, competitive performance. It's really those days of the question of do I have to sacrifice performance to invest according to my values? Those days are kind of gone. We're seeing these types of strategies with lower tracking, competitive, very low fees, actually putting up competitive performance. And that's what we've seen in IQSU, the ETF that we have launched.
Yeah, Todd, you see what's in this ETF, the main holdings, and this is something you and I have talked about many times. You pry open the door of most of these big ESGs, and their top holdings tend to be big cap tech, mega cap tech, or at least high quality big cap tech names like Johnson & Johnson shows up all the time. Can you help explain that to me? And maybe Armando could step in too. I've asked him about it, but it does bother me a little bit. And people keep messaging me saying, Bob, is this all anybody can think of to put in their ESG funds is big cap tech? Why do they keep going in, passing the test of going in? And is there anything else that anybody can include there?
So these are broadly diversified ETFs for the most part. And as Sal just touched on, their goal is to have relatively low tracking error, meaning they're going to perform relatively in line with the broader market. In this case, we've actually seen these two ETFs that we're talking about outperforming within the past year. You tend to have less exposure to energy or slightly less exposure to energy. You tend to have slightly more exposure to some of the more growth-oriented sectors like technology and like consumer discretionary. But it's more what you find not in these portfolios as opposed to what is in there. These are still market cap weighted in nature. So you're going to be heavily weighted towards the Apples, the Microsofts, the Alphabets, but you often don't find Facebook within some of these portfolios. In Sal's product, in IQSU, you don't find JP Morgan or Facebook within the portfolio. So there are certainly companies that you won't find that would be in your broader core portfolio.
Yeah. So Armando, why don't you explain what's in your newest ESG fund, the Carbon Transition Readiness Fund? You just launched it 2 weeks ago. You've got $1.3 billion in this. How do you decide what goes in this? What's the criteria? I mean, it's $1.3 billion for 2 weeks is a pretty impressive inflow. So somebody wants in on this thing. How do you decide what's in it?
Yeah, and I would just emphasize first what both Todd and Saad indicated, which is that when I mentioned the growth is coming from large asset owners and model portfolios incorporating sustainable, this is not just a niche allocation in the portfolio. These are broad exposures that provide a core allocation in the portfolio. So you have to look at your whole portfolio. Are you overweight large caps? That's a consideration, but you should not look for sustainable as if it's a different part of the portfolio that will play in a different space. So in the case of LCTU, which is the low carbon transition portfolio that you were referring to, that was the largest active ETF. That's actually an active ETF offering, but with a low tracking error, given investors exposure to the Russell 1000. So you have exposure to the Russell 1000, but with 50% lower carbon intensity. So that's the key. So you will still have a lot of those names. What do we do in the portfolio? We have about 350 holdings. We look at the holdings in the Russell 1000. We put them through a framework to analyze how those companies are doing in the transition to a low carbon economy. We have a proprietary framework that we use. We give different scores, and we overweight and underweight based on that. But you still get exposure to the Russell 1000. So again, is that broad exposure that you're looking for, Russell 1000 with 50% lower carbon intensity?
So that's the simple answer. When people keep asking me why are tech names showing up in these ESG funds so much, and particularly something like a low carbon, the answer is, well, they tend to be companies that have the lowest carbon footprint. I mean, they're not actually producing anything. Well, they're producing chips. So the next question I usually get asked, Armando, or anybody on this, Sal or Todd, is, do you account for the fact that, for example, Apple produces chips that are, of course, have carbon impact as well? Is there something down the food chain that is also considered when including these companies? I get asked this question all the time.
Yeah, we look across the value chain. We look at the company, at all these companies, across all their activities, across the materials that they use, the use of natural resources, and that's how we come across with different metrics.
Yes, I would agree. We look at that, on the IQ side. Yeah, we look at the whole value chain and how companies, and there are companies, actually large cap companies like Netflix. Actually, one of the big reasons they're actually not in our strategy is that they have a significant negative impact on the environment through the high electricity consumption of their data service. So, just a concrete example of something that actually has gotten filtered out for its environmental impact. Todd mentioned names like Facebook on governance issues. Amazon actually is one that we don't own. That's a very large holding in many of the others. And for there, it's been more for society, the S in the ESG, in terms of kind of the work issues that they have. And we also what happened with the unionization vote down in Alabama. So, we do try to look across all E, S, and G to try to identify companies. They need to be screened out so we can really get companies that are best in class across all three of those metrics.
Yeah, one thing that's very interesting, just to move on this, is it seems ESG is growing so fast that sometimes just managing the flows are an issue. So, Armando, I was looking at iShares Global Clean Energy that you guys run. This is a huge fund that's a real darling of the ESG crowd. And the benchmark, I believe S&P ran this, did the benchmark for this. They had to increase it from 30 stocks. It was a very concentrated fund, which I think is terrific, to 100, just because there was so much money flowing in. They had to be careful about, reducing clustering, essentially. So you're sort of a victim of your own success here, aren't you? I mean, here's a very concrete example where ICLN had to expand the number of companies that are actually in there to accommodate all the people who wanted in on it.
What I would say is that iClean is a very specific thematic type of ETF. It's very different from the exposures that we talked about before. When you look at the LCTU, Russell 1000, when you look at the ESGU, large cap, mid cap, those are broad exposures where there's no issues in terms of the flows. In the case of iClean, also index providers we're still in the early days. They're working in their methodology. And that's improving. That's been updated constantly to accommodate for the growing asset class that we have. But again, when you look at the category, we think that this is going to be a $1 trillion category by 2030. So we are still in the very early days.
Yeah, I think what we're starting to see, too, the broadening out. I mean, we were talking a lot about kind of core holdings and lower tracking error products, and now we're talking a little bit more of satellite-type products where you're looking at some more thematic-type investments that maybe involve some ESG investing. So, for example, we brought out a strategy in February as the IQ Healthy Heart ETF. The ticker is HART, and it overlays the ESG screen, so we're only looking for companies that meet the ESG criteria, but it's very much oriented towards a specific theme. In this case, it's promoting healthy lifestyles through trying to address some of the issues with heart disease. So, we're looking at companies in the healthcare sector. We're looking at companies in the food sector that are actually providing better lineups of more healthy alternatives in their food, as well as companies that are involved in fitness tracking and promoting better lifestyles. So I think what we're talking about here is actually transitioning and broadening out the product suite, the product set, to think about some of these more satellite type of positions that are blending thematics as well as ESG together.
Yeah, thank you, Sal. And Todd, let me just turn to you. I want to move on to another subject. So the two topics I get hit all the time by investors at CNBC on this is, one, why is there so many tech stocks in it? We talked about that. The other is the lack of standards that are developed for ESG that bothers a lot of people, that they have to be very careful at looking at what these ETF funds actually are investing in terms of what they define as ESG. Todd, has there been any advancement in defining what ESG actually is and what it actually is doing? I know there's some groups out there like the Global Sustainability Standards Board that are out there, but are we any closer to an agreement on what ESG actually is, or should we not have an agreement? Should everyone have their own definition?
So I don't think we're that much closer. You're right. There are groups that are trying to have standardization. But I'm not sure this is any different than we have index providers that are behind this that classify companies as either growth or value. And often they'll agree with one another, but often they will not. And so a stock will be in the Russell 1000 growth and will be in the S&P 500 value because there's the data looks different, even though they've got different criteria behind it. This just comes back to you need to understand what's inside the portfolio. If what you want is a core product that's closely aligned to the broader market, and you're comfortable that the 5 largest stocks are the same 5 largest stocks in the S&P 500, but there's a lot of stocks that are not further down, then there's some great products. If you want more of an exclusionary product where it's much more narrowly focused, for example, iShares has an advanced series of products. What's inside those ETFs and what's inside the aware ones like ESGU are quite different.